October 19th, 1987. A Monday that started like any other Monday in America. People were stuck in traffic, sipping coffee, flipping through newspapers. On Wall Street, traders walked into the New York Stock Exchange expecting a routine day. Nothing special, nothing scary. The U.S. economy looked strong. Corporate profits were healthy. Unemployment was low. America felt confident. When the market opened, the first few minutes felt normal. Then, prices started slipping. Not enough to panic, just enough to feel uncomfortable. Traders told themselves, "It's just a bad morning." But the selling didn't stop. Within minutes, screens started flashing red. Phones rang nonstop. Orders piled up faster than humans could process them. By mid-morning, confusion turned into fear. The Dow Jones kept falling, and falling, and falling. There was no single piece of bad news. No war, no recession announcement, no major company collapse. Yet billions of dollars were disappearing. By lunchtime, Wall Street realized this wasn't a normal market drop. It was something else. When the closing bell rang, the numbers stunned the world. The Dow Jones had crashed 22.6% in one single day. Over $500 billion? Gone. Television anchors struggled to explain it. Families watching at home didn't fully understand what just happened. They only knew one thing. Something that was supposed to be safe wasn't. And America had just entered one of the darkest days in its financial history. To understand why 1987 collapsed so violently, you have to understand what Wall Street was becoming. For decades, markets were driven by people. Traders made decisions based on experience, emotion, and instinct. But in the 1980s, something new took over quietly. Computers. Big financial institutions started using a strategy called program trading. The logic sounded simple and safe. If the market falls to a certain level, computers automatically sell stocks to limit losses. No hesitation, no emotion, no second thoughts. On October 19th, when prices dipped early in the morning, those computers activated. They sold massive amounts of stocks instantly. That selling pushed prices lower, which triggered more computers to sell. And suddenly, the market was trapped in a loop. Humans wanted to slow down. Machines didn't. Traders tried to step in, but the volume was overwhelming. Buyers disappeared. Liquidity dried up. It felt like trying to stop an avalanche with your hands. Selling created more selling. Fear fed itself. The crash wasn't driven by bad companies. It wasn't driven by economic weakness. It was driven by speed. By the time humans fully understood what was happening, the damage was already done. Wall Street had learned a brutal lesson that day. Markets could now move faster than people could think. And that realization terrified everyone. When the market closed in New York, the crisis was far from over. That evening, Washington stayed awake. Phones rang nonstop. Treasury officials, Federal Reserve governors, and bank executives were all asking the same terrifying question. What if this panic spreads beyond the stock market? Because a stock market crash doesn't just hurt investors, it threatens the entire financial system. Banks lend money based on trust. Businesses survive on credit. And once confidence breaks, lending can stop overnight. In 1987, that risk was very real. Some banks were already nervous. Market makers were running low on cash. If buyers didn't return the next morning, trading itself could freeze. That's when attention turned to one man, Alan Greenspan, the new chairman of the Federal Reserve. In office for less than 2 months, this was his first real crisis, and the margin for error was zero. Late that night, the Federal Reserve released a short but powerful statement. The Federal Reserve stands ready to serve as a source of liquidity to support the economic and financial system. Simple words, massive impact. Behind the scenes, banks received a clear message. Keep lending. Cash will be available. The system will not be allowed to collapse. Money was injected. Confidence was supported. It was risky, but doing nothing would have been far more dangerous. The next morning, America woke up again. Fear was still there, but uncertainty had softened. Markets reopened. Many expected another disaster. It didn't happen. Stocks were volatile, but the free fall stopped. Banks continued lending. Buyers slowly returned. The system began to stabilize. The 1987 crash was devastating, but it did not destroy the economy, and the reason was clear. This time, the government didn't stay silent. In 1929, the system was left to collapse. In 1987, it was actively supported. Liquidity was restored. Confidence returned. After the crash, Wall Street changed its rules. Circuit breakers were introduced. Trading halts became standard. Limits were placed on automated selling. The market survived, but something important was lost. The belief that modern finance was invincible. 1987 proved that even a strong economy could be shaken in a single day. And that lesson stayed with America long after the headlines faded. For many people, Wall Street felt far away. Traders, suits, numbers on screens. It didn't feel like everyday life. But in 1987, the crash reached far beyond Wall Street. It reached living rooms, teachers, factory workers, office employees, people who never bought a single stock in their life, because their money was still connected to the market. Pension funds, retirement plans, 401s, K-keys, all of them were tied to stocks. And when the market crashed 22.6% in one day, those savings took a direct hit. People didn't see it immediately. Statements arrived weeks later. And that's when reality sank in. Years of savings, suddenly smaller. Retirement plans pushed further away. Some people delayed retirement. Others started saving more and spending less. Businesses felt it too. Hiring slowed. Expansion plans were canceled. Risk-taking stopped. Not because companies were suddenly failing, but because confidence was shaken. The crash created a quiet ripple effect. Fear didn't just stay on Wall Street, it moved into everyday decisions. And America learned something uncomfortable. You don't have to participate in the stock market to feel its consequences. Over time, markets recovered. Stocks climbed back. Headlines moved on. Life felt normal again. But Wall Street did not forget 1987. Behind the scenes, regulators studied every detail. What failed? What almost broke? What barely held together? New protections were put in place. Circuit breakers to pause trading, rules to slow down panic selling, systems designed to give humans time to think. On the surface, the system looked safer, but something else was happening at the same time. Automation didn't stop. It grew. Computers became faster. Trading became more complex. Decisions that once took minutes now happened in seconds. The market survived the crash, but it also became more dependent on technology than ever before. 1987 quietly marked a turning point. It wasn't just a market crash. It was the moment finance entered a new era. An era where speed mattered more than patience, where reactions mattered more than reasoning. And while the economy healed, Wall Street carried the memory of how close it came to failure. That memory shaped how markets would operate for decades. Even after the headlines faded, 1987 never truly left Wall Street. Inside banks, trading floors, and regulatory offices, the crash was studied again and again. Not emotionally, but mechanically. What broke first? Where did fear turn into collapse? How did selling overwhelm the system so fast? The answers were uncomfortable. Markets had become too fast for human judgment. Technology had removed hesitation, and hesitation, it turned out, was important. So Wall Street adjusted. Circuit breakers were introduced to pause trading during extreme drops. Automatic halts were designed to slow panic. Risk controls became mandatory, not optional. The goal wasn't to prevent losses, It was to prevent chaos. 1987 also changed how institutions thought about risk. Before the crash, diversification felt like protection. After the crash, it was clear that in moments of panic, everything could fall together. The idea of systemic risk moved from textbooks into boardrooms. Most importantly, 1987 changed behavior. Traders learned that markets could break without warning. Banks learned that liquidity mattered more than profit in a crisis. Regulators learned that silence could be deadly. The crash didn't destroy Wall Street, but it forced it to grow up. The 1987 Wall Street crash is often remembered for one number: 22.6%, the largest single-day drop in U.S. market history. But numbers don't tell the full story. What made 1987 powerful wasn't just how fast markets fell. It was how close confidence came to disappearing entirely. No factories stopped working. No companies suddenly failed overnight. The economy itself wasn't broken. The system was, and that distinction mattered. Because it proved something important. Financial systems are built on trust, not certainty. When trust holds, markets function. When trust breaks, even strong economies can shake. 1987 ended without a depression, without mass unemployment, without collapse. Not because the danger wasn't real, but because action came in time. That's why Black Monday still matters. It wasn't the day America's economy fell apart. It was the day America learned how fragile modern finance could be. A reminder that behind every screen, every trade, every system, confidence is doing most of the work. And once confidence is tested, history shows just how quickly everything can change.